rising. Retail inflation overall has been very, very steady. So, well, here's the first take on the index. A strong opening as suggested. The Nifty is up almost about 80 odd points. The Sensex is up about 300 points. So, good opening, decent opening, you'd have to say. The mid-cap index really is the one that's up almost just about flat. And let's see how that one goes.
Well, that's right. In terms of stocks that are moving around from the broader markets, a few of them should come up for you on the screen. CNBC Enterprises, that's opened up with gains of close to around 1% or thereabouts. You have a couple of other notable movers as well. I'm looking at the broader markets, actually. A few stocks that are moving on rather large volumes. Just want to pull some of them up for you on the screen. Let's get in a few of them. You have ITC, obviously, that's the top mover out there. You have South Indian Bank, that's up close to around 2%. On the downside, a few stocks that are seeing a lot of selling pressure. Tourism Finance, big volumes, big underperformers, been getting smacked in the last few days. So keep an eye out on that one. Suzlon, we saw some kind of bottom fishing in yesterday's trading session. But that one, again, is down on very large volume. But Sonia's gone across to the ball. Sonia, tell us more.
So, you were talking about some of these broader market stocks. I thought I'll take it to the large caps as well. So, ITC, let's see how that one's looking this morning. The big overhang is now out of the way. Brokerage upgrades have come through post that stake sale. So, 5.5% higher on ITC, 427 on that stock. Cipla is also in focus. That stock has been having a very strong run lately. Now the company has got the US FDA tentative nod for a hypertension drug. So keep an eye out on Cipla, up 0.5%. You were talking about Shree Cement as well. That company will be buying 5 ready-mix cement concrete plants in Mumbai for 33 crores. So some corporate action over there. Aurobindo Pharma, UGI Pharma has started distribution of aseptic products manufactured at Unit 3. So Aurobindo Pharma is up 2% at the moment. Glenmark in focus as Nirma has completed acquisition of 75% stake in Glenmark Life. Titagarh has been in focus for the last many days after bagging a lot of orders. Once again, it's launched a second 25-ton pull tug for the Indian Navy. So some, positive news flow over there. But the stock is seeing a little bit of profit taking. Macrotech is in focus. The promoters have sold about 50 lakh shares via block deals at 1180 rupees a share. So just keep that on your radar. It's seen a big rally, but today, little bit of profit taking there. Signature Global has launched a new project under the affordable housing policy in Gurugram. So that stock in focus as well. And a couple of other names that you mentioned a while back is what we are looking at. Sterling and Wilson do now down almost about 5%. Shapoorji says that the stake sale reports is factually incorrect. So the company has come out and said, address those stake sale reports. But otherwise on the market, folks, it's not bad actually, the opening. Decent opening, you'd have to say. The Nifty Bank is higher by 120 odd points. But ITC, that's the big one in focus this morning.
ITC indeed is the big one. In terms of market cap addition, it is like adding half of Britannia, half a Godrej Consumer, and nearly all of Marico to its market cap. And if you're still feeling a little iffy out there, that's like 4 Mama Earths added to its market cap in today's trading session itself. But talk about some other stocks as well. BSE is the one that stands out in terms of an up move. It's up around 3% this morning. There was a note coming in from Jefferies as well that the 1% cut to transaction charges made by the NSE would be a periodic exercise by them, and the quantum is smaller. BSE's product pricing and monetization plan of new products will be unaffected by that, and they expect to see an earnings jump of over 2.5 times over the next couple of years. They have a buy rating with a target price of nearly 3,000 on BSE. The other stock which is doing, okay-ish, largely flat right now, is Jubilant Foodworks. That's something that we'll be watching out for. There is a bull and a bear case out there. The bull case is that, there is a positive development that they've had with regards to the movement in Turkey and Bangladesh. But the bear case is that sales for India business itself haven't been growing higher, and there is the risk of that Turkish lira depreciation in that business as well, still holding mildly in the green. A couple of these auto ancillary names are doing well as well. JBM Auto, for instance, is higher. We're seeing decent moves come by on GMR Power as well, which is up around 3%.
All right. Well, Tahir Badshah, CIO, Invesco Mutual Fund, is joining in now to tell us how to approach the markets. Tahir, hi, good morning, and thanks for joining in. So, everyone's talking about how the mid and small cap space is under pressure. But to be fair, the small cap index is down 6% this month, but it was the biggest performer last year. So do you think the concerns are unwarranted, or would you now start to get a little more cautious about what's happening in the broader markets?
So I think, Sonia, we have been moving a little more cautiously compared to what we were, let's say, during the later part of 2023. And our view has been that while we still feel that overall the market is constructive and even the broader markets are reasonably constructive, but we we have somewhat, we have to worry a little more about risk compared to what we were in 2023 because valuations have gone a little elevated compared to last year. So I'm not necessarily surprised to see the correction, and a modest correction was on the way. Probably we have seen, like as you said, about a 5-6% correction. Much of the correction up until now has been driven by the valuation argument. It has not necessarily come down to the stage where we have started to question the earnings capability or the earnings power of the broader market in the near to medium term. And to that extent, therefore, I would like to think that the correction should not probably be very deep. We've seen, like as I said, about a 6-odd%. Can we do another 5-6-odd%? And then valuations start to turn reasonably more favorable for one to take a lot more constructive stance. Meanwhile, we also need to understand, quite a lot of the recent correction has been induced by some of the regulatory headwinds that we have faced both from the market regulator as well as the financial regulator.
Right. One other stock which is actually doing better in today's trading session has been United Spirits. It's up around 1.5%, more to the high point of the morning so far. And this perhaps because the street is reading a little more into the tweet that was put out by Prime Minister Narendra Modi, where he did say that they reaffirmed their commitment. That's with regards to the UK-India Free Trade Agreement. He had a good conversation with PM Rishi Sunak, and they expect that there could be an early conclusion of a mutually beneficial free trade agreement. If that was to happen, then all the bulk scotch that comes into India will perhaps not attract as much duty, and that may be margin accretive, provided all other taxes remain the same as well. So that's something we'll be watching out for. Tahir, your thoughts on specific spaces, consumption in particular, discretionary, where a lot of people are positive because they believe, the wealth effect is leading them to buy better, not necessarily more.
Yeah, I think so. This whole consumption space has had a very divided kind of, scenario, seen a very divided kind of scenario in the last some time. And that trend by and large still continues. I think, from at least a growth standpoint, the mid to higher end segments of the market clearly seem to be relatively better placed in terms of further growth momentum. We can always argue about what companies in that particular space, but stocks of particular companies in that space are doing and where valuations are. But by and large, I think that is something which appears to be relatively more structural. Wealth effect is obviously a little more pronounced in that segment of the market. It's not to say that the mid to lower end segments of the market are not seeing wealth effect, but the impact is relatively muted, and it has been there for some time. I think that also to us seems like there could be a possibility of a cyclical recovery out there, and the impulse on growth out there could probably be a little stronger than what it has been in the last 2-3 years. But that's something that we are approaching very tentatively. We are examining some pockets of that segment which have underperformed and where growth has lagged. But I think the upper end of the market clearly seems to be in a strong saddle and seems to be a lot more structural in nature.
Okay, all right. Hi, Tahir. Tahir, when we met the last time around, you were saying that, BFSI is still worthwhile, though you didn't have any exposure to gold financiers. RBI has wrapped the knuckles of a couple of NBFCs or financial institutions in the last week or so. What's your view currently? How would you approach this entire BFSI theme? Will it be private? Will it be public? Or is there select NBFCs that you like?
So I think, Nigel, the last time that we would have discussed, I would have also probably said that, we did start to develop a preference more for the banks. We didn't really call out as much on NBFCs. We still are relatively light on NBFCs. You mentioned that we also don't have exposure to a few segments. But that divide or that tilt still remains, that we are still a little more bank heavy than NBFC heavy. And then on the other side, we are obviously heavy more on some of the non-lenders. So, to that extent, that probably has worked out reasonably well, I would say. So the preference still continues a little bit more for the banks. The impact has been relatively less for the banks from a regulatory standpoint. And within the banks, I think there is a edge of private sector banks over public sector banks to some degree. And not to say that we don't have a presence in public sector banks, but incrementally, do we see a little more value and the growth differential and the valuation differentials now having kind of, leveled off between the two parts? We think so. And that is a view basically that we are going with, at least for 2024 as things stand now.
Okay. I know you may not want to comment on individual stocks, but I have to ask you about this move on ITC, right? I mean, um, the market is hungry for companies, good quality companies where valuations are looking attractive, and ITC is one of them. Do you think FMCG in general is that space which will now start to perform as valuations are not as expensive as some of its peers?
Yeah, so time and again, Sonia, these stocks in these segment have, presented themselves as a value proposition, and we have taken advantage of them as well. But, at times we want to, uh, are they deep value? Probably not. Are they value in a certain context relative to their growth? That needs to be examined. And in certain cases, we see some bit of, like, as I said, a growth impulse as well, whether it be in the FMCG category or even in the consumer discretionary space at the low to mid end of the market. But we need to see it in conjunction with the growth outlook. And yeah, like as I said, I mean, there is a cyclical possibility. I mean, we are looking forward to inflation cooling off, and that obviously has affected these segments. So there can be a cyclical rebound if inflation starts to continues to be on its easing path. We obviously have the initial monsoon assessment that should come about in the next some time, and that'll provide a good cue in terms of what we can expect out of this segment as well. Um, so I think it's we are examining it, as and when we see opportunities around it, but we don't want to be in completely deep value pockets either.
Where else are you finding value right now? Because, everyone's talking about this optimism around India, but also it coming at a price. A lot of foreign paper has been supplied into India. They're doing the valuation arbitrage here. We've seen, as Sonia pointed out earlier as well, the third foreign promoter actually cashing in on the Indian chips that they own. What are your thoughts? Where do you find value right now at a market which is so hot, so to say?
Yeah, so what we are seeing is relative valuation pockets, not necessarily on absolute terms. Absolute terms, probably where we see value is, like as we discussed, only in the banking and financial services space, and could probably include even some select NBFCs. But apart from that, in most other pockets, it is more of relative valuation. We do see some, not necessarily strong value, but we see relative value in, let's say, the pharma space. That's something where we see the earnings rebound to be relatively stronger. And while even there too, valuations in the recent past have moved up, but compared to, let's say, the 5-year averages, we are not at very extended levels, and dynamics are changing out there as well. So we are looking at value pockets where we see simultaneously certain inflection points. I mean, if they're without inflection points, then it becomes a little difficult to spot. I think we are tentatively approaching, like as I said, some of those lower end segments of the consumer market. We are also, examining certain pockets in the commodity space, which perhaps have underperformed, and where we could see somewhat better headline growth compared to what it has been in the recent past. So it's selective. I mean, I wouldn't call that. We all know that it is not a market where we've got some very value which is strewn around all over the place. But I think these are the pockets where if we hunt a little more closely, we're likely to find some opportunities.
Okay, all right. Tahir, how are you placed on the autos? Two-wheelers, some of them have rebounded big time. Bajaj, Hero, they've done quite well. Royal Enfield had a bit of a scare, but that one as well has bounced back quite well. On the two-wheelers, how are you placed? And on the whole, what do you like from the auto space at this juncture?
Yeah, so I think in the GAP segment section of the market, clearly two-wheelers at this stage is appealing, and this is where we are a little more exposed, I would say, compared to, let's say, and is where we have probably added to positions in the last some time compared to, let's say, the four-wheelers. And it's interesting to see that the product momentum in the two-wheeler segment, whether it be in EVs or even in the ICE segment, is of a somewhat better order compared to what it has been in the last 2-3 years. And in fact, we are taking a little bit of that segment as a possible indicator of a more broad-based revival in the lower end of the market. It traditionally has panned out that way. We'll have to see how it goes, but that gives us that little extra confidence that we might be able to find some more ideas in that space. So clearly in the auto space right now, it is two-wheelers. We are not too excited about the four-wheelers. There are a couple of places where now valuations have become a little more reasonable, or even to some extent, I would say cheap. So maybe there is some attraction out there, but heavy positions are largely in two-wheelers and auto anchs.
But in two-wheelers also, just one follow-up there, names like, say, a Bajaj Auto, TVS Motor have already been, big gainers, right, in the last 1.5 years. So do you believe that this is a structural upcycle, that there could be lots more to go and it's just the initial phase in two-wheeler names?
No, so clearly, once again, in this segment, there are winners and there are companies which are executing a lot more strongly compared to some others. And, in certain cases, the entire revenue mix is doing reasonably well, whether it be their two-wheeler portfolio, whether it be the EV part of the two-wheeler portfolio, in certain cases, even the three-wheeler opportunities. So, to that extent, we are able to tolerate somewhat higher valuations in some of these, especially if all cylinders are firing at the same time. And they've got their, like as I said, product profile and they've got their execution, and then that makes a lot of sense. So I think there too we are approaching it with the view that, look, I mean, we are paying somewhat higher multiples, but as you said, maybe I don't know whether I should call it structural, but it has also been a cycle which has been quite weak for a good number of years, and therefore, can we have a 2-year upcycle? We are probably in the first year of that. That's quite possible.
All right, Tahir, thank you so much for joining in. We'll leave our conversation at that itself. Thank you for your insights on the market and a lot of sectors where you find relative value and some in absolute value as well. Though, there is weakness in the market, no two ways about that. We've been talking about the weakness in the broader markets. The advanced decline charts come up for you. When we started the show, we had nearly 1,000 stocks advancing for about 500 stocks which were declining, but now that has swiftly moved on. The intersection of those green and red lines have come about, and now they're at the widest point that they've been this morning, with nearly 1,350 stocks on the red side, with around 780 stocks on the green side itself. The mid-cap index down about 0.7%, and the Nifty too has moved into the red. And this, mind you, despite a 40-point up move coming in on account of ITC itself. So no taking away from the fact that there is a deeper weakness in the broader markets. And one of the stocks that tells you this story is Titagarh Wagons. They've, or rather Titagarh Rail Systems now. They've won an order worth nearly 1,900 crores a couple of days ago. They also announced the launch of another second 25-tug pull tug for the Indian Navy. And usually these news pieces would take all of these rail stocks higher. But look what's happened to Titagarh. It's currently at the lower end of today's trading session itself, down about 3%. So maybe the street is in the mood of profit booking itself. But be that as it may, for this 1,900 crore order that has come by, what are the prospects? Is there any upside? And the execution timelines? We have Umesh Chaudhary, who's the Vice Chairman and MD of Titagarh Rail Systems, joining in. Good morning, Umesh. Thank you so much for joining in. Every time we speak to you, it's on the back of a big order that you've gotten. This time around, it's around 1,900 crores coming in from Indian Railways. Could you tell us, what the execution period for this is, margins, and what does this take your order book to?
Yeah, hi. Good morning. Always a pleasure being with you. So this is an important order for us because this is for a new design of wagon which we got an order for.
Oops. Umesh, I think we've lost your video there, so we'll just come back to you in a bit.
Someone's pulled the chain on that train.
I couldn't hear him or see him, so we'll get back to that in a bit. But by the way, guys, you should look at the broader markets because that is the big concern area. Look at it now. The mid-cap index is suddenly down 420 points, and that was the point we were making earlier in the morning as well. While the headline index is fine, it's steady, it's the broader market pain that is really hitting retail investors quite a bit. So right now, 400 points gone on the mid-cap index. The advanced decline ratio is at 1,500 stocks on the declining side. So that is the big headline at the moment. But back to the discussion.
Back to the discussion. Yes, Mr. Chaudhary, I believe you can hear us clearly. Let's hope we can hear you clearly now as well. You were telling us a little about the order.
Yeah, absolutely. So I was saying that this order is significant for us because this will be executed in just under 2 years from now. And this enables us to maintain the market leadership position that we have currently in the wagon space. So it's an important order for us.
Okay, it's an important order. Can you tell us a little bit about what the total order book that you're sitting on currently is about 28,000 crores, right? How much of that will be executed in the next 1 to 2 years? And, what is the kind of order visibility that we're looking at? If you can help us with some details.
So we operate in two segments, the freight and the passenger. On the freight side, the last order book that we had declared along with our December results is what I can actually speak about. So that was about 28,000 crores divided half and half into both the segments. In terms of the order pipeline visibility, so in and execution, so we announced along with our December results that we were able to break the glass ceiling of making 1,000 wagons in the month of December. And our target now is to make sure that we are able to consistently maintain that. So we believe that by Q1 of FY25, we will be able to hit a run rate consistently of 1,000 wagons a month. That is where we intend to be for a while now, unless we see the new dedicated freight corridors and the next big demand of wagon going upwards. In terms of the passenger rail segment, there are many tenders in the pipeline. We have the Chennai 2 tenders, we have the Mumbai 3 tenders for the metros. Of course, the new Vande Bharats that have been in the media that will be announced, but probably after elections. So we see for both the segments, the visibility is quite large, and in terms of the execution of the passenger side, the Pune Metro will be executed in the next couple of months. The order will be completed, and we are starting with the Bangalore and going on with the Vande Bharat and Surat, etc. So both the segments, I think, are going pretty much as per target.
Just to get the number, the total order book is 28,000 crores, right? If you can just break it up for us on the freight side, what is the order book and what's the visibility like?
So on the freight side, the total order was approximately for the wagons about 7,000-8,000 crores, and I'm speaking from memory, so I can be a little bit here or there. And then there was the wheel, our share of the wheel project, which was the balance. And on the passenger side, including the maintenance, was about half of that. So it was if I look at the wheel and the wagon as one pocket and the passenger on the other, it was equally split between the two.
Okay. Hi, sir. Good morning. Nigel on this side. Just want to confirm this order that you won. In which segment does it fall?
Freight.
The recent
it's
order?
on the freight side. This is the wagon order.
Got it.
Right.
Wagon order. Also, if you could tell us, you told us by when you will execute it. That's the next 24 months or so. But what are the margins you'll enjoy?
So the similar margin. So on the freight side, we've had about 12% EBITDA margin. 11-12% is what we've been maintaining, and this order also would be no different than that.
So 11 to 12% is on the freight side. Now the next trigger of revenue recognition will come in as you execute the passenger segment. Like you said, there'll be the Bangalore Metro, Pune Metro, and all these Vande Bharat orders that you would be giving. What margins do they typically apply at?
So if you look at, and as you said very rightly, Mangalam, that up till December, almost 80% of our revenue or even more was coming from the freight segment. In FY25, we will really start getting the revenue from the passenger segment, which will significantly ramp up in FY26 when Vande Bharat execution starts. In terms of the margin that we have in the passenger segment, if we look at the bare coach, when we are buying propulsion, we expect a 10% EBITDA, which will increase to 15% when we are able to do our own propulsion, for which we have now the technology tie-up or the TOT with the ABB. So ultimately, if we look at the passenger segment, the targeted EBITDA margin that we have is around 15%.
Okay, EBITDA margin is around 15%. Got it. Can you tell us, in terms of the private sector orders, what is the expectation currently? What is the execution looking like? What is the visibility?
So we have a significant part of the private wagon business as we speak, and we don't normally give the split between the two, between the private and the Indian Railway wagon for competitive reasons. But I can say that for certainty that we have a significant market share, if not market leaders, in the private segment also. And the visibility
currently?
looks very good. And this is clearly driven by the economic activity. So, right now, because of elections, new capexes will be a little slower. But as soon as the election is over, we will see new capacities, whether it's steel building or cement or all of that come up. And that will again bring up the demand for private sector wagons. Having said that, we have substantive orders right now, which will see us through for at least the next 8-10 months on the private sector wagon also.
Okay, all right. Final question, sir, before we let you go. What is the execution outlook? Order book is looking superb. You're bracing yourself to go to 1,000 wagons per month in FY25. On the base of FY24, what kind of a revenue growth can you deliver? Point number one. And give us the blended margin for the business that we should be working with.
So, in terms of the execution in FY24, we were hovering at the run rate of around 700 wagons a month, and going FY25, we are targeting a run rate of 1,000 wagons a month. So that pretty much gives you a kind of a sense of.
You want to give it to us, sir, in revenue terms? In revenue terms, you want to give it to us?
We don't, as a matter of policy, give forward-looking projections. So
Right.
I would refrain from doing that.
Let's try it this way. Umesh, you have a higher share of revenue coming in from passenger, wagons, which will be better margins. What are the realizations per wagon that you're targeting next year? Let's put it that way.
So realization for freight wagons continue to remain the same. So it is not changing. It doesn't change apart from the normal price variation, which is reflective of the inflationary trends. So the revenue per wagon hovers between 35 to 40 lakh per wagon, and that is where it will be. The volume what will drive the overall top and bottom line. On the passenger side, we were at about 3 to 4 coaches on an average, if you look at FY24. This we are targeting to take it to almost 15 coaches, 12 to 15 coaches in FY25, and then double it up from there in FY26, and then further increase in FY27. So the real big delta will start coming in from the passenger coach segment, and while the freight segment will go from 700 to 1,000 in the next year.
So, basis your numbers, roughly 4,800 crores is what we're gathering, because 1,000 wagons per month at between 35 to 40 lakh per wagon would mean about 400 crore revenue per month. Multiply that by 12, 4,800 crores. Would that be a fair estimate?
You have better mathematics than I have.
All right. Thanks a lot for joining in, though. Appreciate your time here on CNBC TV18. Let's step into a quick break. On the other side of the break, Ameera Shah of Metropolis Healthcare will join in to talk about the new advanced diagnostic testing centers launched by the company. Later, we'll connect with Lalit Agarwal of V-Mart Retail to talk about demand trends and their business outlook going forward. Stay tuned.
Welcome back. Well, as we speak, the markets are flattened out, but the real action is in the broader markets. You have the mid-cap index is down 1%, and the small-cap index as well is down close to around 1%. So some pain continues in the broader markets. Well, let's focus on Metropolis Healthcare. They've launched new advanced diagnostic testing centers in Maligaon, Maharashtra, and in Dehradun. To discuss these centers as well as their expansion plans, we're now joined by Ms. Ameera Shah, the promoter and MD of the company. Hi, Ms. Shah. Morning. Thanks so much for joining in. Well, before we get to these expansion plans, just wanted to ask you first, how is the competitive intensity in the industry as of now?
So, broadly, I think we've always had lots of competition in the industry. It's not something new. I think healthcare services has traditionally, and especially diagnostics, people assume it to be a low entry barrier market, which is true because there's no regulatory framework and capital required is low. However, what I think people realize after they enter that actually the barrier to scale and the barrier to earn good quality business is very difficult. And that's where you will end up having lots of companies in the industry. But a lot of them become zombie companies after 5-6 years of trying and not being able to really succeed in the way that they estimated. So I think competitive intensity was there, continues to be there, but is lower from a perspective of aggression, pricing, discounting than it was a year ago.
Got it. All right. So it's easing a little bit. That's the takeaway from what you're saying. Going back to the expansion plans then, how many labs have you added in this fiscal so far? And what's the plan from here on?
So our target was to add about 30 labs this year, and we're very much on our way to get there. So hopefully by the end of this month, we should be close to that target. And we've also added approximately 600 centers, new centers all across the country as well. And that's the kind of pace that we look to keep going. Even next year, we're looking to add about 30 labs and again about 600 to 650 centers. Across, mostly in tier 2, tier 3 markets and markets in which we are challengers in the country, across the north and the east and the central part of the country. And of course, while we'll keep going deeper into our core markets of south and west, we'll also continue to broad base our entry and access points into northeast and central.
Okay. Ameera, hi, good morning. This is Sonia here. I take your point about, the brand strength and how that is sort of helping you overcome competitive intensity. In fact, in your B2C segment as well, you've seen a growth of 13% in patient volumes, and that B2C is 53% of your overall sales. Just tell us, is this double-digit growth something that you can sustain? What are you doing in the B2C segment to strengthen your brand presence pan-India?
So you're right, Sonia. If you look at it, the volume growth in B2C was 13, but the revenue growth was closer to 17-18%. So it's been very strong. And, really what we've been doing is about, Metropolis we've always built our business on the back of science and expertise and not on deep discounting. And we continue to do that. So it's about really having a right to win as far as your service and your product and being able to communicate that to doctors and specialists all over the country. And, with that belief in our brand and what we bring to them, which helps them in their treatment, is really how we are able to drive the B2C. Which is basically having earning our trust with doctors. Now, what happens is once in a market, you've been able to earn your trust with doctors, and over time, it becomes a consumer brand. And then you can also do D2C, which is direct to consumer activities that will, bring the consumer to you directly as well. Now, the mistake often people make is thinking that, we can go directly D2C. But if you haven't earned the trust of doctors in the meantime, then frankly, the quality of business you'll get from D2C will not be so great.
Okay,
right.
So just one follow-up here. The overall growth rate in the B2C segment for the industry is expected to be how much in the next 1 year? And how much will Metropolis's growth rate be? I'm talking about FY25.
Sonia, that third-party data is unfortunately not available for our industry at all. We don't even get really overall growth data for the industry. But my estimate is the industry is growing at about 10%, year on year. Where the unorganized segment, which used to grow at about 5 to 6% per year pre-COVID, is actually growing slower, and the organized market is actually growing a little bit faster. This 10% is obviously a combination of volume, price, RPT, combination of everything. And as we've seen in the first 9 months of the year, our core diagnostics growth has significantly outpaced the rest of the industry as well as the rest of our listed peers. So I think we want to continue focusing on volume plus revenue per patient plus pricing as the three levers that will lead us to a superior revenue.
So let's talk about all those three drivers itself. What is the kind of volume growth that you are targeting in the next quarter and maybe FY25, if you can give us a sense on that? The price hikes that you've taken so far, the target price growth, and finally coming in from, your new centers? I remember you saying that the revenue coming in from new centers and premium centers would increase in contribution. Where do they stand and what's the target there?
So if you see Y to date till about December, we've done about 9% volume growth, which has been sort of significantly higher, like I said, than the industry. Plus, we've had about 3% of revenue per patient growth, which is really about the product mix changing and people moving up sort of more advanced testing. And that increases the revenue per patient as a single prescription point. We have rolled out our new pricing initiative on Jan 1st, 24. So that impact will come in Q4 and obviously for the next year as well. So we don't have a specific number on that yet, but that should add a few percentage points as well.
So the B2C price hike has been absorbed is what you're telling us. No worries on that front. What about B2B? I think you'll be looking at pushing through a price increase there as well. When is that?
That's right. The original plan was to do it in Q1 of FY25. But I think we've already rolled it out in Q4 as well.
Okay. The premium wellness space is something we've discussed ad nauseum, right? But it's a space that's also picking up in a big way. There are wellness centers sprouting all over metro cities. But for your own business, it's done pretty well. I mean, your Q3 premium wellness revenues were up almost 15%. Tell us a little more about how you're planning to expand this segment and how you're planning to, sort of cut away from competition.
See, again, I think it comes back to your product, your offering, your service, and the trust in the brand, right? So when there is a lack of trust in the brand, and when I say trust in the brand, our business is not built on the back of hoardings and marketing materials. It's really built on the back of experience when you're unwell. And who are you able to trust when you're sick? Usually you trust the best doctor, the best hospital, the best diagnostics, and that's the kind of reputation that we have. So people understand that when they're doing a wellness checkup or an illness checkup, they're doing it once a year, and they're not spending huge amounts of money on it. Usually when you come for a blood test, you're spending maybe 1,000 rupees, 800 rupees on it. It's not a huge amount of money, for an upper middle class customer. And you're doing it once a year, right? It's not a repetitive thing. So people are actually tend to be more careful about where they go, and they're not looking to just get excited by discounts and cheaper prices and all of that, because they also realize that tracking their reports, their results, their data from the past, all of that is meaningful to the health. So I think overall we are seeing that the premium wellness segment is basically bundling. But with the brand trust we enjoy, people are willing to pay fair prices for it because they don't find them to be expensive. And even here, the price points are closer to 2,500 to 3,000. It's not like it's 20,000 or 10,000.
What's also standing out is the fact that you are looking to grow beyond metros. An advanced diagnostic center that you've opened in Malegaon, another one in Dehradun. You are looking to expand beyond just the metros, and that's where a lot of people are eyeing consumer opportunities as well. What I wanted to understand are the economics of opening stores or diagnostic centers outside of metros. How do they compare with mature stores when it comes to revenues and cost? And would there be a bearing on your margins on account of something like this?
So usually in a tier 2 market, you're starting what we call as a stat lab, which is you're doing about 150 varieties of tests. Unlike the 4,000 varieties of tests that we do in our global reference lab in Bombay, right? So you're starting a smaller limited test menu in that market, but you're offering all 4,000 tests to, let's say, all the citizens of Malegaon or Dehradun, right? Because you can do some testing locally, and some of those samples will then flow to the closest lab where you are able to do everything else. For specialized tests, for semi-specialized tests, the pricing is actually the same across the country. It's only for routine tests that we have some adjustments based on the local market. So overall, you find that there's not a huge difference in pricing. But in your cost base, there is a big difference. Because, obviously your OPEX costs are lower in these tier 2, tier 3 markets. So overall, as a weighted average, and really the dependency is on where you have a strong brand with doctors and medical community, and where you don't have still a very. So in markets where we have a very strong brand, we see a quicker payback. Markets where the brand is not as strong, it takes maybe a year and a half.
So how should one read margins going forward? Should we see an improvement, or should we see them maintained at the current levels where we are?
So currently we are at the peak of our accelerated lab expansion, like with 30 labs, and next year will be the same, which is FY24 and 25. But post FY25, we are going to then go back to adding, 8, 9, 10 labs a year like we used to in pre-COVID. And that accelerated program will stop. And therefore, the drag on the margin, which is currently about 1.2% because of this accelerated lab expansion, will certainly reduce and come to a complete end by FY26-27.
All right, Ameera, always a pleasure hearing your thoughts. Thanks so much for stopping by and filling us in with all of those details. Wishing you well and looking forward to chatting up with you post your quarterly numbers. By the way, we need to keep an eye out on the markets. We have dipped below the 22,300 odd mark. So good time to get in Mitesh Thakkar. Hi, Mitesh. Welcome back on the show. Well, the market started off well in the green, but you needed some more participation from a couple of other heavyweights to build on. That hasn't happened. Would you be looking to buy into this dip on the Nifty as well as the Nifty Bank? Give us the levels out there and then fill us in with your picks.
No, Nigel, I think good morning. I've been advocating, selling into this market via put options route and saying that 22,250, 220 is the first support area. But the way the indicators are positioned, there's a stronger chance of us breaking below that level this time. And if that happens, 21,950, and in the worst case scenario, 21,800 can be tested. So maintain a negative bias. We've disclaimer here that I've bought 22,500 April expiry puts. So I have vested interest. I have a position in that sense. But yeah, I think the overall outlook is slightly on the negative side. Similarly, the Bank Nifty, I think once it breaks 47,200 or 150 on the hourly closing chart, then I think we might see the Bank Nifty dip to about 46,500, 550 levels. So mild negative bias on both the indices. Okay. On the stock side, sorry.
Please go ahead. Please go ahead.
Yeah. On the stock side, PNB is a sell. We had a sell on PNB yesterday as well. It's a recommendation to our clients. So again, there's vested interest. But keep a stop at 126. Look for targets of 117 here. And the other stock is Colgate-Palmolive, which I would take as a contra bet on the long side because we have mostly short positions. So Colgate is a buy with a stop at 2587 for targets of around 2670.
Okay, thanks a lot for that. Well, the market is definitely taking a turn for the worse now. The Nifty is down 55 points and the mid-cap index is really out of shape as we speak. 860 points gone on the mid-cap index. A lot of pressure seeping into the broader markets there. But let's focus on V-Mart Retail. The stock is down nearly 10% in trade in the last 1 month. In Q3, the company saw a single-digit same-store sales growth while margins were around 17%. The demand environment has been quite subdued actually. How is business looking now? We are joined by Lalit Agarwal, the founder and MD of V-Mart Retail. Mr. Agarwal, good morning and thanks for joining in. You have spoken to us in the past talking about how demand is under pressure in certain pockets of the market. Can you just give us a little more, color on that? How is the situation in Tier 2, Tier 3 cities, in the rural markets? Have you seen any improvement as far as consumption patterns are concerned?
Yeah, I can see you.
Yes, Mr. Agarwal, can you hear me?
I can hear you.
Okay.
So,
yeah, go ahead.
I heard your question. Yeah, so the demand definitely has been creeping upward and better. There is still some pain in the smaller town. There is still some pain in the consumption because the inflation pressure has been continued on the base of a high inflationary piece. So, but yeah, we are seeing some green shoot because we reported some single-digit quarter in the last quarter, single-digit like-for-like growth, and we are expecting a little similar kind of growth continuing also in this quarter. Definitely till this time, it has not been so great, but March should be a good month. This is what our expectation is because there are a lot of marriages as well as a lot of festivals which are coming up in the month of March. So we should see some betterment coming in the month of March as well as April.
Okay. When you say some betterment, can you just quantify that for us in terms of a revenue growth or a volume growth? What are you looking at? Because your same-store sales growth has been in single digits, just about 4% in the quarter gone by. By when do you think you can get to double digits?
I think it will take some time for us to reach to double-digit numbers, and that's what our expectation always would be. But right now, whatever we are seeing, we will be hovering around the same single-digit number, and that's what it looks like. The way the consumption is growing, the way there are income generations happening in the market, the way customers is able to have a disposable income, we are seeing some kind of pressure there. But yes, definitely we are seeing green shoots coming in, and those are the good news which are being seen from a lot of markets, especially from Tier 4 markets. Some of these green shoots is making it much more confident, us much more confident that this is going to be definitely a better year for us coming year.
So, we have a lot of other triggers as well, the likes of elections, etc. Tier 4 market showing some green shoots. Mr. Agarwal, what does it imply in terms of growth targets for the next year? What are you looking at in terms of same-store sales growth, revenue growth, and maybe some bit of margin improvement for the current levels that we're seeing?
So next year we are definitely hopeful, because we definitely know that election do bring in a little more money into the market, and it is a better economy after that, and especially in rural as well as the semi-urban towns. So we are expecting a better outcome coming forward. Definitely there will be highs and lows, but yeah, we are expecting a higher single-digit same-store sales growth, and overall higher double-digit same-store or total growth. And that's what we are expecting. And there are a lot of initiatives that we might have initiated in terms of its ability to provide the best value for fashion to the customer. So we are actually focusing on improvising our internal processes, our internal capability to deliver the better fashion to the customer, and then targeting that customer. So that is which will also bring in some kind of result. That's what our expectation is.
Okay, all right. Hi, Ms. Agarwal. Good morning. Good to see you in. Nigel on this side. Yarn prices as well have dipped a little bit. How does it help you, and what's the outlook on margins?
Yarn prices have been moving a little upward and downwards. There was almost a 1 month of period where we saw a little higher in the yarn prices, but it is now coming down. So largely, see, we don't create a clear correlation with margin, and these yarn prices are only maybe 30% of the total apparel cost or 25% of the total apparel cost. So there is some impact which does happen on those, but largely we believe that the margin should be constant. But yeah, because the consumer is in pressure, we have reduced our average selling price for this year, and we have gone almost like 10% lower for the complete year. So in the next year, we would want to keep our prices stable, maybe take it down a little bit more, but not focus on increasing the prices, because we believe our customer is in pain and we need to support them in those pain. For that, we are definitely bringing in a lot of new processes, new sourcing mechanisms, and integrating with mills and fabric or manufacturers, so that we are able to deliver a quality product with the best of the fashion which is available to the customer. There is also a lot of innovation by these textile companies, and there is a lot of innovation in terms of mixing the polyester as well as cotton yarns. So there is a lot of new kind of fabrics which is coming to the market, and because of PLI schemes, a lot of investment is also happening in the textile sector. So some of those things are also bringing down the price of the fabric, which is also making it reasonable for the customer to afford those apparels.
All right. Thanks a lot for joining in and giving us an update on the business. Let's step into a quick break. On the other side, we'll put focus on the commodity space with Manisha Gupta. Stay with us.
Welcome back. The market's weakened a lot, and the Nifty at the low point of trade right now, down almost 65 points, over 100 points off today's high as well. In the mid-cap index, that's where the pain is, 2.5% lower. The index has shaved off 1,100 points. 2,000 stocks now declining for about 200 stocks, which are advancing. So there is red all over the screen. Is that the case for commodity space as well? Perhaps we'll get to Manisha, and she'll tell us the commodity that she's tracking today. Manisha.
Well, thank you for that, Mangalam. I'm looking at an underperformer within the metal space, and that clearly is iron ore prices. We saw nearly 7% of a decline at one point in time in the China markets there. So when you look at the last year, it was a 25% of gains. But in last 1 week, we've seen 4.5% of decline. The last month has seen 14% of a cut. And in this year, until now, we are down by 25%. So all the gains that you saw in the previous year are done away with in the first 3 months of this year itself. This is to tell you on how the iron ore prices have been moving. Well, we did see an all-time high of $229 a ton. That was way back in July 2021. By 2023, we did see prices decline quite a bit. In 22, we saw a low at $85, and from since then, it really has been between 85 to 150 on the higher side of a range that the iron ore prices seem to be trading within. Now, when you look at 23, the range, the lowest was 99, the highest was 145, and that's exactly how we started January 2024 as well. We started Jan with $142 a ton, and currently we are trading at around $110 on the lower side here. So it has been a sharp correction that we've seen on the lower side. As you can see, it only has been a one-way decline that we've seen in case of the iron ore prices in this year until now. Well, China accounts for 70% of the global seaborne iron ore, and we do understand that the inventories there are quite strong. This is what we've done in sense of million tons of trade for the last couple of years. It has been increasing, and as I said, even at 1,700 tons of an anticipated global trade of iron ore for 2024, 70% of that will happen from China, and that is where major concerns really seem to be building up in. So when the property demand comes in, that number has been on the weaker side. The last few data from China have been slightly positive. So whether it's about shipping, machinery, auto and infrastructure, we have seen some better steel and iron ore demand coming in, and that is perhaps where we are getting support from as well. But it also has to do with the high iron ore inventories. Australia and Indonesia are pushing out a lot of iron ore. Yunnan in China is saying that they will cut steel output by nearly 300,000 tons to 500,000 tons. So that would mean lower iron ore demand, and that's weighing onto the prices as well. Also, with Moody downgrading the second largest property developer in China, Vanke, to junk rating is also weighing onto the markets, with Street now telling us that while the iron ore prices are trading at 110, but watch out for $100 a ton as well, and that could perhaps happen in the next couple of months itself.
Okay, thanks a lot for that. Well, moving on, Vivek is joining in with details on the FTSE and the Bharat 22 indices rejig that is expected this week. Vivek, over to you.
Well, that's right. So the flows or the actual rebalancing will happen in the trading session of Friday, that is March 15th. Now, all the flows that we have are as per IIFL Alternative Research. So the FTSE rebalancing event, is a positive net inflow event as far as Indian markets are concerned. In fact, it's quite sizable. It's a $1.85 billion inflow event, the entire FTSE rejig. Now, which there are 16 stocks that are being added into the main index that we track. That is the FTSE All World Index. Couple of stocks where there will be higher impact given the kind of flows and when you're comparing to the average daily traded volume. So the first stock is Sundaram Finance, almost $160 million of inflow. Suzlon Energy, over $110 million of inflows. The other set of stocks, all in the range of $50 to $100 million is what they will see. So you'll see names, you'll see inflows in names like Phoenix Mills, KPIT Tech, Jindal Stainless, Prestige Estates, Thermax, LJV and Metro Brands, NLC India. NLC India has been very volatile in the last couple of trading sessions. Metro Brands, Poonawalla FinCorp, FACT, that is Fertilizer and Chemical. You also see Kalyan Jewellers, Melcon Dock, RVNL and New India Assurance. These last four names will see flows in the range of $10 to $20 million. Now, along with that, Bharat 22 ETF2, that also will see a minor rejig in terms of weight changes. So which are the stocks that have seen getting their weights added up? ITC, Axis Bank and SBI will see their weights gaining. On the other hand, there will be outflows on account of weight decreases in BHEL, NTPC and Power Grid. Now, very important to note is HDFC Bank. FTSE will go ahead and implement the third and final tranche of its weight increase in this particular rejig. So HDFC Bank will see inflows of over $450 million on Friday on account of this particular rebalancing.
Okay, thanks a lot, Vivek, for that. Let's slip into a quick break. On the other side of the break, we'll get you excerpts from our conversation with the top macro voices at the Citi India conference. Stay tuned.
We're still in the early phase.
Well, at the Citi's 2024 Investor Conference, Prashant caught up with the chief emerging market economist of Citi, Joanna Chua, and began by asking her about the China +1 factor for India, India's growth trajectory, and lots more. Listen into the slice of that conversation.
We're still in the early phase of that process. Clearly, when you look at surveys of greenfield investment, I think that there's a lot of optimism in India. Obviously, India has had a lot of positive momentum from previous reforms, like the PLI schemes, a lot of improvement in infrastructure. So from the timing perspective, India has had its own domestic reforms happening at a time when the world is also looking for alternatives of China +1. So you have this coincidence of once. So I think it's positive. Of course, the challenge here is that you also have a global manufacturing cycle that we need to see demand to be strong enough. And the challenge here is that China, it's not like China is going to give up its dominance in global manufacturing without a fight. And China is still very competitive. And we can see that across a broad array of goods. So that does pose a little bit of competition. But for now, especially for India's domestic market, there's a lot of long runway to go. So I think we are very optimistic that this manufacturing story can continue.
How would you rate it? I mean, it's an unfair question maybe out of 10. I mean, how many marks would you give this process? Because the other country which has benefited and which perhaps will benefit is Vietnam, right?
Yes.
And that also ranks in the conversation as one of the big beneficiaries. But where would you rate India?
Okay, so in Asia, I mean, globally, obviously, people also look at Mexico for nearshoring. But in Asia, you're right, Vietnam and India ranks high. Of course, the challenge for Vietnam is still a very small country, right? And it depends a lot of its supply chain ecosystem with neighboring China. So they're very linked. And so I think the challenge here is that, to a certain extent that Vietnam doesn't have a large domestic market, it also has to face competition for nearshore. Like if you want to service the US market, which is where a lot of exports in Vietnam go to, you have to kind of compete with nearshoring destinations like Mexico because you don't have a large domestic market. Now, the nice thing about India is there's a lot of large domestic market, and that makes it more attractive for companies also to go into India. Of course, you have to balance the ecosystem for investor climate and whether there's enough of a complete ecosystem of supply chain in India. So, I think in Vietnam, it's very linked to China, and China has a very complete ecosystem. The question is, will India be as open to imports of parts to make that kind of a seamless kind of manufacturing kind of system is something that needs to be we need to monitor, because obviously India also wants to develop its own domestic supply chain, but these things don't happen overnight. These things take time.
Is there a hindrance? I mean, the PLI schemes, the government supporting sort of own industries. There are restrictions on certain imports, etc. as well. Import substitution is a big theme here in India.
Yes.
So are these two aims at odds with each other, or you think they'll run parallel?
I mean, look, there are sometimes, as I said, sometimes you've got trade policy as a way to support, you use trade policy in India as a way to support import substitution. But at the same time, it's not yet complete. And, you have geopolitics that we have to monitor too. Like China and India relationship is obviously very complicated. If you have a lot of restrictions to certain Chinese goods, or restrictions on, say, Chinese issuing visas to Chinese nationals that you need to kind of provide a bit of intermediate inputs, that could create a little bit of friction, right? So I think, again, it's not as seamless, so we need to manage this. And I think India has to be pragmatic, that they have to recognize that some of the intermediate goods they have to accommodate, and some of that inevitably will be coming from China, and then we have to see how that transition goes.
In terms of the business environment, business climate, is it the best ever? How would you rate it? I mean,
certainly. I've been coming to India for many, many years, and clearly the optimism and vibrancy, I haven't seen it as optimistic as we are seeing it now. I've been impressed by the amazing infrastructure. Again, a big part of manufacturing competitiveness is logistic costs. It's not just labor costs. And for sure, there's been a dramatic improvement. But, India is a large country. It's a democracy. Sometimes there's also regulatory issues that you still need to kind of address. But definitely it's on the positive trajectory. And that's what matters to markets. Markets go where they think there's a positive momentum. And I think certainly India has that.
And of course, growth here has been one of the strongest in the region, in the world as well, right?
Yes, absolutely.
And that's well recognized that...
the real GDP growth that came out at 8.4%, that overshot everyone's expectation, including ours. So I think that also continues to attract money. Again, we are in a world where people are looking for new growth opportunities. China is going through a lot of structural challenges. It's not going to be able to grow as it used to. The unwinding of real estate is going to take a long time. And you've got, to a certain extent, geopolitics that may not unwind anytime soon. And you've got a kind of a model where there's a lot more state intervention that's impacting people's confidence. But in India, I think, again, coming from a lower base, there's a lot more optimism. It's more geopolitically neutral. So that seems to provide a lot more avenues. And to the extent that people are looking for alternative, destinations, that's also diverting capital flows to India.
Do you think geopolitics could be a dominating driver in terms of how trade flows also take place? Because we have US elections. Looks like it's going to be a rematch between Trump and Biden. And if you go by current opinion polls, I mean, you'd give Trump a slight edge even. So are we looking at another big trade war with China? And then how does that sort of effect actually help India?
Well, first of all, there's good and bad, right? Anything that creates a lot of trade and policy uncertainty, drags down global growth, right? Because that creates a lot of uncertainty for investment. So there's also obviously some income effect, but there's also substitution effect, right? So you're absolutely right. When you look at some of the rhetoric coming out of Trump's campaign, it's a bit mixed, right? You see things like 10% across the board tariff, kind of non-discriminatory.
I heard 60%.
But then you also have 60% targeted to China. Now, I'm hoping that is just, typical kind of a Trump opening salvo for negotiation. I hope we don't actually get the 60% because that would be very, very disruptive. But you do certainly fear that the antagonism on trade rules are going to be more skewed against China than other countries. And that will kind of probably escalate even the desire to kind of diversify. But again, that is also quite destructive for global growth. But I think India certainly will still benefit from substitution gains. And because India is still a very domestic-oriented economy, so trade as a share to GDP is not very high. So in a way, from a kind of the global, your beta to the shock of global growth, you're a little bit more insulated. And again, as I said, to the extent that, I think we saw Modi and Trump's relationship was a much more cordial relationship. If you think India-US alliance is going to be much stronger, that could again create more positive substitution gains to India as well.
All right, Prashant also caught up with Samiran Chakraborty, the chief economist for India City, and spoke to him about his interaction with the global investors and what do they make of this India as an emerging market. Take a look.
India is now the darling among EM countries, and that has been there for a while. I guess we don't need any more convincing on India macros to global investors. In fact, the most common question for us is what can go wrong rather than what can go right. And that's great. And we expect that this will translate into significant amount of inflows into India. We've traditionally seen a lot of equity inflows, but this time around the focus seems to be more on bond inflows. I think most of the fixed income investors that I have met not just the EM-focused investors, but also some of the global funds. They're all preparing for the bond index inclusion and bringing in money. And I would not be surprised if the actual inflows turn out to be more than what the mechanically arrived at number is. The question really is on equity investor flows. While the positivity on the macros are there are some concerns on valuations. So that's an area where we would probably still have to wait for things like election results, etc. And then the third aspect is the FDI flows, where everyone is looking at their own India strategy, so to say. But again, my sense is that there could be a bit of a time lag between designing that strategy and the actual inflows.
On elections, would I be wrong in saying that consensus does expect Mr. Modi to come back as Prime Minister? There's a little doubt on that?
I think that's where the market consensus is right now. The way I would put it is that the political and policy continuity is already quite well priced in the market. What people are asking us about is the so-called policy delta. What can change after the elections? Are we going to see a significant amount of structural reforms being unleashed? Because in some sense, the whole fiscally conservative, control over inflation, manufacturing push, infrastructure push, these are stuff which investors are by now very familiar with in the Indian context and want this to be continued. But are we going to see more of the land reforms, labor reforms, privatization, agricultural reform, those kind of stuff also coming into the policy playbook? That can significantly alter the way investors would look at India going forward.
Would you say you need some of that stuff for that delta?
I think so. I think that is something which people would want to see because, as I said, that valuations in their mind has obviously reached a point which is built in a lot of this macro good news and the policy continuity, political continuity. So to see a higher premium for India, we need to do a bit more is what my sense is.
Out of the 3 or 4 things you mentioned, which is the one most doable sort of reform in your mind or area which can be tackled?
So clearly, labor reforms is a place where we have already passed the bills in the parliament. They just need to be enacted on. And the privatization is also an area where we have made some progress and possibly with some political capital we can push it even farther. The more contentious ones are the land reforms and agricultural reforms because it affects a much larger segment of the population. So we will have to see how this can be done in a relatively less disruptive fashion.
You spoke about flows. Before bond inflows, etc. I'll come to that in just a bit. What about FDI sort of inflows? 2023 was not a great year. I mean, I think...
Again, the data needs to be looked at with some precision here. The actual gross FDI inflow is only down 7%. The problem is that the net FDI inflow is down 45–50%. That's because there's been a significant amount of repatriation out of India. And by the way, this trend in falling FDI, India is not unique here.
Sure.
Almost all EM countries have seen this. Part of the reason could simply be that higher interest rates in developed world might have made cash stay back there rather than being invested. But I would say that if I look at the trend in gross FDI flow, that decline is not that worrisome. 5–7% decline is par for the course, can happen from year to year, could well be reversed also. The question is that the repatriation that we have seen could be because, particularly in private equity venture capital world, there could be some profit taking in India which could have gone into rebalancing
a lot of that.
their portfolios. are we at the end of that cycle? I think that's something what we need to watch out for as we move into FY25. So we have a slightly more optimistic projection for FY25 in our FDI flows, primarily because we think that large part of this repatriation process is already behind us.
Do you think it's behind us?
I think so. I mean, that's what is there in our forecast, especially when interest rates will be likely to be cut in the developed world in FY25. That's when there could be a renewed emphasis on bringing that money into the EM world, and India would benefit out of that. Also, I think there is a bit of a lag between this whole the China +1 discussions that we are having in the Indian context. So we have part of a lot of these discussions, but not as much of that has got translated into flows, which could happen with a lag in FY25 is what our belief is.
Okay, got it. On the bond flows, so this is JP Morgan index inclusion will happen this year, then there's a Bloomberg index emerging market will happen next year. Cumulatively, what kind of flows are we looking at?
So it's tough to put a finger on a particular number because there are a whole host of issues here, including even how much is going to happen as a pre-positioning before the index inclusion per se. We've already seen about $9 to $10 billion of inflows into bonds from the September inclusion announcement date. So, but mechanically speaking, this number is supposed to be about $23 billion. Our suspicion is that it will turn out to be higher than that, not lower than that. And increasingly, what it will do is that even funds which are not tracking this index directly, they will have a reason to start investing into India because of the market depth, liquidity, everything that this will bring in. In fact, that is probably the learning that I had in my recent conversations, that it's not just the index tracking funds that will be bringing in the money. It's often even the non-index tracking funds, including some of the global funds, which will start making some allocations towards India. And if we start getting newer indices like Bloomberg's or FTSEs of the world joining the party, then you could see this number to be even larger. But the only thing I would put a caveat on is that this is a one-time flow. From next year onwards, we are not going to get $25 billion like every
one stock
year.
adjustment in a sense.
It's just a one-time stock adjustment. From next year onwards, the flow could be 2, 3, 5 billion, but not really 25, 30 billion. So that is, fiscal arithmetic, we have to keep that consideration in mind as well.